What's up, everybody? This is Keith. I'm with Chris Sweet, and today we're going to be talking about how to create a working plan for financing your business. Because at the end of the day, there's a lot of people saying, hey, go out and get loans, go do all this stuff, but you've got to have a plan. There's got to be a strategy. You can't just go out and get stuff if it's that easy. If it's that easy as a business owner, just run out and get money anywhere, we'd have a lot more business owners. So today we're going to help you. I'm going to help you think through the strategies for creating a plan for actually financing your business. And these are going to be practical steps of how you can start today to even get credit, to be able to get things that you need to be able to start on this journey. So we got a lot to cover, but before we jump in, we do have a live event going on right now. Actually, it is the Business Credit Building buildingchallenge.com. I'm throwing it in the chat for you guys here. Challenge.com. And Ty is actually over there right now. We've got hundreds of people that are in Zoom, learning from him about how to build business credit, going through the exact steps. So as much as I love you guys being on here and hanging out with me, if that sounds like something that you'd be interested in attending and joining, feel free to jump on over there. It's free. You can register. You'll get access to our platform to be able to get in there, get the training, and get everything you need. So that's businesscreditbuildingchallenge.com. It's going on yesterday, today, and tomorrow, and there is the recordings are still in there. So a lot of good things happening. It's a lot of fun. We love helping people out. So let's jump into creating an actual plan for financing your business. Now, like I said at the beginning, one of the things that you have to watch out for is that everybody's going to tell you, oh, there's all this money out there for startups, for entrepreneurs, for people with small businesses. There's a lot of money out there, but the money being available and being out there and actually you having access to it are two completely different things. And that's what I want to help you do, is to formulate that strategy to be able to get the financing you need to free up your cash flow and to start moving into progressively better financing options as your business grows and as things start to take off for you. So before we actually get into the plan, the first thing we need to do is we need to talk about what kind of financing is available. We need some definitions here. We need to think through what exactly are your options. So the first one, if you guys follow us online, and if you don't, this is a good time to hit the button, like, and subscribe, because we always have great education and great tools coming at you. But the first thing to consider is business credit. And what business credit is, it's actually the ability of your business to be able to get approved for lines of credit, business credit cards, different options like that, even vehicle purchases in the business name. So it's not tied to your personal Social Security number. You're not having to put a personal guarantee down on it. It's really a great option to be able to run your business, be able to fund the things that you need. The second option you have is alternative financing. Alternative financing gets into we'll dive into all of it, but really it's the go between business credit and traditional financing. And traditional financing is exactly what you think of when you think business loan. It means you're going to go to the bank, you're going to walk in, you're going to sit down with a banker, explain your situation, and they're going to sit down, type some buttons into a computer, and tell you whether or not they can give you a loan. Alternative financing kind of falls in between there, where they're more concerned about the strengths of your business. So the first thing the first thing that we're going to cover is, how are you financing your current needs? What's the first step to be able to create the plan, to be able to get where you need to go? So the first step in this process of getting financing and really funding your business the way that you need to get it to grow is using business credit. The reason we're going to start with business credit is very simple. Business credit takes time to build. It's not something that you can just apply for it and instantly you're going to have hundreds of thousands of dollars of credit at your fingertips. It takes some time to build. It's really about a 6 to 9 month process of getting things up and going. And the reason that you want to do this, one, is that it is going to get you to that point where you can get 10, 20, even 100 times higher credit limits than you can personally. But the other side of it is you're building your business credit report. Now, just like when you go out and apply for a loan, like whether you're getting a house or you're buying a car, they're going to look at your personal credit. With business credit, it's used to determine it's used to determine your approvals when you're looking at alternative financing and traditional lending. So not only are you going to get the credit that you need to free up your cash flow and to get access to the goods and services you need and the credit cards and the credit lines that you need to be able to start getting things moving, but you're also going to be setting yourself up so that you can get approved for higher business loans as you're moving forward in the process. So the next thing that we're going to look at is we're going to look into alternative financing. And when you look at alternative financing, the reason it's called alternative financing is very simple. It's not following the traditional rules of lending, of business lending. Now, if you've ever sat down with a banker, and you've gone through this process, they ask you everything. They jump into just about every part of your life, every part of your business when you're going to a bank and asking them for money. So they're going to sit down, they're going to look at your situation, they're going to look at your personal credit, they're going to look at your collateral, your debts, your income, and they look at your 401ks, your personal 401ks with traditional lending. Alternative lending and alternative financing in the business world is very specific to three separate categories. You've got cash flow financing, you've got collateral based financing, and you've got credit financing. And these are the three C's of financing that we talk about all the time. These are the cornerstones of business lending. So with alternative financing, the thing that's great about it is that you don't have to have everything together all at one time. When you see ads or you see articles or videos that talk about being able to get approved for business loans even with bad credit, a lot of times that's leaning into the alternative financing world. And so for example, you can, if you've got even $5,000 a monthly recurring revenue, you can prove it for 3 to 6 months. You can get approved for cash flow financing options. That cash flow financing is just going off of the fact that your business has consistent cash flow going into a business checking account. It's not, you can get approved with less than perfect credit. The better your credit, the better the rates and terms are. But you can get approved even if you've had prior issues on your personal credit, because again, alternative means that they're looking for other ways to qualify you, meaning that simply they're qualifying you based off of the fact that your business has money coming in, and that there's cash flow coming in on a consistent basis. Sorry, I'm moving things around on my screen, kind of lose my place here. The other side is collateral financing. So alternative financing, when you have assets that you can put up to secure a loan, that's where the collateral comes in. So securing a secured financing or collateral based financing can include things like 401ks, stocks, bonds, mutual funds. It can be equipment. One of my favorites that I think is probably one of the most genius ways that I've ever seen alternative financing is invoice factoring, where if you're maybe like a white collar business that you're sending clients invoices, or you're in a B2B service that you're sending out invoices to other businesses to get paid on, you can actually use those unpaid invoices to secure financing based off of what they know is coming in. It's a really cool program. And again, if you're interested in finding out more about that, it's called invoice factoring is the technical name. But collateral can also include like equipment. If you're in a construction industry, let's say you've got trucks, you've got tractors, you've got all this different equipment. You can get financing to get you approved for it. But the other side is you can also get financing if you own it outright. It's called a equipment leaseback option. And what you're doing is you're selling the asset to the bank, and then they're giving you money for it. You keep the equipment. So let's say you have a backhoe that your construction company owns. You'll actually still have access to it. You can still use it. You can still run jobs. You can still get paid for having that. But now you're going to have cash in your pocket, and you're going to repay that loan back until you own the equipment again. It's a great way to secure financing if you need it, if you get into a pinch. Now, a lot of times when you're looking at like collateral financing, the places that I've seen that this really becomes effective is when you're looking at equipment financing. And so let's say you have something break down, and you're in a position that you can't make money without that equipment. Now you have the ability to actually get money from the equipment that you're going to use to repair with it, and keep the business going, keep yourself flush, and have the ability to be able to get the money that you need. So we've covered cash flow and collateral for alternative financing. The third option is credit financing. Now, we just talked about business credit beforehand. So business credit kind of stands in its own unique place. The reason that business credit stands alone is because a lot of the business credit lines that you're looking at are gonna get approved with companies that you're gonna buy things from. So this could be Home Depot, Lowe's, Menards. It could be fuel cards. It could be Apple. It could be Dell. It could be any place that you're buying the equipment that you need to actually service. That you actually need to service your clients and make sure they're taken care of. But the difference is with business credit, you don't actually get access to cash. You can get credit cards, but you can't get cash. With alternative financing, if you've got good personal credit, you can actually go in and secure loans just based off of your credit. It does require good personal credit on that. The other two, the cash flow and collateral financing, not as concerned with your personal credit, even if they are at all. But once you get into the credit side of alternative lending, if you've got good, strong personal credit, you can get approved for even secured loans, or I'm sorry, not secured loans, but term loans, meaning that if you borrow $20,000, you're going to have fixed payment amount, or even lines of credit or credit cards that you can leverage and be able to use for the growth of your business. Now, that being said, I don't want to be elusive about what good, strong credit means in the business lending world. When lenders are looking at your business credit profile, they're not just pulling it up and go, oh, well, they got a 700 credit score, we're going to get you approved. Because the way personal credit works is you can have a great business credit score and not have much credit at all. Meaning that, like I've seen, I've worked in the credit industry for a lot of years. So I've seen students come out of high school with one credit card and they're like, I've got a 730 credit score. Yeah, you do, but it's not really a 730 credit score because there's no depth to it. So when you're looking at business loans, you're looking at business financing options. They're also looking at the depth of your credit. How many credit cards do you have? Do you own a home? Is that home reporting? Do you own vehicles? Do you have anything that's paid off? They're looking for the depth of credit and long-term stability of you as the individual securing this financing option. So credit scores sometimes don't play as much into financing in the business world if there's other factors. If you've got really good, really strong credit, really deep credit, maybe 6, 7, 8 different trade lines that are reporting a couple accounts that are already paid off, and having those open for a long period of time goes a long way. Now, look, we're not personal credit finance coaches here. There are a lot of people who excel at that and they do a great job. But one of the things that I can tell you that I see people consistently mess up on is they get started with some of these smaller personal credit cards to build their credit. And then once the American Expresses start rolling in and Discover and all these flashy benefits and it looks great in your wallet, they start to close out these starter accounts and the accounts that they've used to build their credit. Leaving credit cards open it has no negative impact on your personal finances, especially if you're not even using it. If you're not running balances on it, there's nothing there. But having that length of credit on there does wonders for your credit. It brings depth, it brings stability. It shows banks that you know how to properly manage credit, not just a little bit, but for years on end. And that's what banks are looking for, especially in the business world. They want to see that you're savvy enough to be able to have good credit and maintain that credit for a long period of time. So if you're looking for business financing, you're not afraid of using your personal credit, using your personal credit to secure alternative financing is definitely an option. All right. So we covered business credit. We covered the 3 different C's under alternative financing. Let's talk about traditional lending. Traditional lending, as I mentioned before at the beginning, traditional lending actually gets into going into a bank. When you sit down with traditional banks and lenders, what they're going to be looking for is they're going to be looking for 2 to 3 years of tax returns on the business. And they're going to be calculating, okay, how much did you spend? How much profit did you make? because at the end of the day, that profit margin, the amount of profit that you claim on your taxes, which by the way are due today, don't forget those. Everybody's anxiety peaks today because of that. But they're looking at the profit that you're claiming on your taxes to be able to determine how much they're going to loan to you. One of the things that I see, especially like small businesses or people who are just getting started, they want to go in and they want to hide all the money. They want to claim as much as they can. They want to add all this depreciation in and put their books in a position where when a lender looks at it, it looks like your business is upside down. When you start getting into the bigger lending options, you start talking with banks, at that point, they're going to be looking at that. If you don't have that profit in there, basically you're telling a bank that you don't have enough money within the business, within your current operations to pay them back. So these are things to be thinking about as you're working into this, because again, we're creating a working plan for financing your business. So we've talked about business credit, alternative financing, and now traditional lending. So how do the three of these actually play in together? And what are the advantages and disadvantages of each? So this is where we have to start implementing some strategy. Now, like I said earlier, if when you're getting started, business credit is where you want to start because it's the one that's going to take you some time, but it's also one that's going to be able to grow with your business. So as you're consistently using it, you get higher credit limits, meaning you get access to more credit, and then you get higher limits. And it's something that you can build. It's something that can grow with your business and grow with you as the entrepreneur. Um, Business credit to me has always been the underlying factor of all financing. And the reason is because again, it has that third-party verification. It gives banks the ability to look at a business credit report from Dun and Bradstreet or Equifax or Experian Business. And now they're able to go in there and see from a third party saying, yes, hey, ABC company over here, they actually pay their bills. They have credit. They're using it. It's consistent. So business credit is the other. Sorry, my brain's running faster than my mouth. The other side of business credit that I like is that you can actually use it to fund your daily operations. Now, when I'm saying fund your daily operations, I'm not saying that business credit's going to give you $100,000 put into your account and you can just run off and you can go do what you want with it. But it does mean that as you're making purchases, you can put it on your business credit. And even as you're getting started and you're working with vendors and businesses that are offering net terms meaning that it's due by the time that net term is expired. Traditionally, most of the time, you're going to find that's going to be like net 30, meaning that once you purchase something, you have 30 days to pay that off before it's negative or before it's over past due, and you get a bad mark on your business credit. But what that does is it makes it where instead of money constantly coming out of your business checking account, now you've got the ability for the money to actually show up and for you to pay out that money at the end of the month. So you can make calculated decisions. Or another way to look at it, you can use business credit to buy the goods and services that you need to fulfill the services, get paid on it, then go pay off your credit lines. So what your bank account looks like is it stays a lot more stable. So for example, if you're a home remodeler, you put in a bid, you get your initial payment, you go to Home Depot and you buy all your supplies and you buy everything that you need on credit. Now instead of having the credit that's instead of that cash flow coming out of your business, that cash flow is or sorry, I'm getting a message. Now, instead of that money coming out of your checking account, that money is going onto that line of credit, and then you're able to pay it off at the end of the month, meaning that your checking account's not always just up and down, up and down, up and down. It's a lot more consistent. The reason banks like this is because it gives them the ability to see kind of what your bottom operating line looks like. Because if you're running a balance of, let's say, $25,000 a month in your checking account, and they see that, and they see that you're paying your credit lines off, opposed to running everything through your checking account and maybe lowering that to $15,000 or even $10,000. Now it shows the stability of your company, and lenders love that. So business credit's a great way to operate the business, get what you need from it. Alternative financing, is a great way to be able to stair step or to hit different benchmarks in your growth as a business owner. What that could look like is, let's say you get to the point where you're a startup, you get 6 months, a year into it, and now you're at the point where you're doing consistently $10,000 a month. You can use cash flow financing to be able to get ahead, make a little bit of a bigger purchase, and invest that money into something that's going to pay you back quickly. Some of the ways that I've seen our clients use this that makes a lot of sense is they'll use cash flow financing for running ads. They'll start an ad campaign, they'll start running it, they'll see something that's working. They're positioning themselves where they're getting a predictable return. Then they're comfortable going, you know what, let's go ahead and get this cash flow financing. Let's invest in a bigger campaign. Let's invest this money because I know that if I'm able to put $15,000-$20,000 in on this ad campaign, that I'm going to make $40,000 or $50,000, essentially doubling my money just because of this one loan. Alternative financing is a good way to fill in the gaps as you work towards the traditional lending options, being banks or SBA, things along those lines. Now, why do you want to work towards traditional lending? Because traditional lending is where your big growth comes in. This is where you can start acquiring properties. This is where you're able to be able to start doing big expansions, to be able to get money, to be able to take over your competition, to be able to bring people in, to actually have growth capital, to be able to look at the big moves that you need to make, the hires that you need to make. And that's ultimately the goal that you want to get to, is the place where a traditional bank, SBA lenders, any of those types are going to be able to look at your situation and want to give you money. And the way that you do that is you stair step your financing. You have a plan. You operate out of business credit. You start filling in the gaps and using alternative financing to accelerate your growth until you get to the point where you can hit those 2-3 years of good tax returns. You've got the collateral, you've got the credit, you've got all of your bases covered. You've got all 3 C's covered, where the banks are going to want to loan you money for that growth because it's going to be positive investment for them and a positive investment for you, and their risk is relatively low. So this is just kind of this is an overview to be able to help you understand how financing is going to work. Be able to have a plan to be able to be able to get started. If there's anything that you need in this process, feel free to reach out to us and let us know. Part of what we do is we sit down with you and look at your situation and go, okay, here's where your business is at. Here's what you need to do to be able to start building business credit and getting financing. And then we'll create a plan with you. We call it a business financing assessment because we're going to assess where you're at, what you're currently doing, and what you can improve for, or what you can get approved for right now, as well as helping you put together a strategy of what you can get approved for in the future. If you want more information, if you want to find out about that, you can go to creditsuite.com/consult. Our team's there. You can schedule a free assessment with us. We'll sit down, look at everything, and help you out. Appreciate you guys hanging out with me today. If you have any questions, feel free to leave comments. We check these daily and are more than happy to make sure that you have everything that you need. And that's all I got for you for now. And like I said, if you're interested in building business credit, we've got the Business Credit Building Challenge going on right now. You can learn more about that at businesscreditbuildingchallenge.com. All right. Hope you guys all have an awesome day. And until next time, have a good one.